Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Tuesday, June 2nd, 2020. Sort of a mixed day here in the US. Looks like they tried to get it rallying with the sort of usual overnight rally, but it seemed to peter out, and I think we're seeing some mixed trading at this point in the day, and we'll see where that takes us. We'll see if there's a late rally to come or if it just sort of meanders. You know, we were waiting for the president to speak. As of now, he hasn't said anything substantial, but he typically does arrive late. And so, there's various back and forth. But what's interesting today is some of the beaten down sectors, some of the sectors that had not been participating are participating in the rally today, or sort of leading. Two of the better performing sectors are oil and banks, both of which have had their challenges. The oil story, I don't have to go over yet again. We all know what happened to oil. It got beaten up, and still, even though the price of crude oil has bounced, it's still below the cost of production for many domestic U.S. oil companies. So that's problematic. Also, the demand is still not really picked up because people aren't traveling the way they were. But hope springs eternal in some of these sectors. And banks, it's a terrible environment for banks. The interest rate, the yield curve, banks profit from some steepness in the yield curve because they can borrow short, lend longer. If those rates are the same, that doesn't give them much of a spread on their borrowing versus lending, which is where they make their money. It's perhaps reasonable to think that if there's some economic recovery, and with the amount of debt the U.S. has to raise, and world economies for that matter have to raise, then possibly you could see some steepening of the yield curve, which would be beneficial to banks. As with so many of these things, the market's looking way down the road. Got to admire the market's tenacity in the sense that basically, yet again, markets are sort of looking forward and saying, okay, things will be back to normal in a short period of time. The economy will be okay. The Fed will continue to have your back. Probably, it's hard to disprove that, except for the fact that I see no evidence of that being the case. I saw a statistic today that we're looking at economic growth that's going to take us 10 years to get back to where we were. That is not priced into the stock market right now. Now, we are sort of seeing some signs of life in other places. One of the reasons I think that futures rallied overnight, and for what I'm going to call as a good reason, is we've been seeing some real rallies over in Europe. The DAX is basically all the way back to its 200-day moving average, having fallen quite considerably. There we're seeing the prospect of fiscal stimulus. Some may ask, what have they been waiting for the last 10 years? But if that's a sea change in Germany in psychology, then that's something that is market friendly. There is talk in the U.S. about another round of stimulus. The House did pass over $3 trillion stimulus bill, which was promptly construed as dead on arrival in the Senate. They're going to have to work that out. There is some rumblings that might work out. I've gone through the rationale of why the stimulus was particularly good for U.S. equities, because a lot of that money that people received actually, rather than flowing into the economy, flew into the stock market. Depending on how the stimulus is allocated, that could be a good sign for equities, because money could flow back into the stock market. I'm going to take a wait and see approach on that, because it's not clear to me what they will agree on and under what form stimulus will be reaching people's bank accounts, or brokerage accounts in this case. So there's some back and forth. We're seeing some of it. Yesterday, I think we saw some rallying, partially because it was the beginning of the month. There's always the theory that money flows into the markets at the beginning of the month because there's new asset allocations. I buy that to a certain extent. And I think that's probably what propelled some of the late Friday into Monday rallying. The news flow continues to stink. But let me just put something else in your mind, which is not exactly intuitive. Stock, a lot of people have started to compare what we're seeing in the U.S. to 1968. And 1968 was really not a bad year for the stock market. The S&P ended up the year nearly 10%. after having some declines at various points, obviously the economic backdrop was very different. A lot of what was being propelled then was still civil rights, but there was also a Vietnam War going on, but the economy was generally in good shape. Now the parallels fall apart because the civil rights aspect is an unfortunate constant in U.S. society, but the economic backdrop is quite different now than it was then. There's a lot to unpack. It's an ongoing theme. If you feel comfortable, well, I guess trend is your friend. If you don't feel comfortable, well, I think, as I said yesterday in a written piece, no one ever went broke taking a profit. Have a good afternoon. Take care. Bye-bye.